It will also shed 25% of its corporate staff, meaning 1,500 job losses at its Boston headquarters. GE shares fell 7.7% to $1, its lowest in more than 5 years, as investors worried that a years-long transformation would not pare down enough expenses or generate as much cash as they hoped. They need to cut more cost, said Scott Davis, an analyst at Melius Research. GE is still a bloated company with duplicate costs up and down the organization. Flannery, who took over as CEO on August 1, said he was looking for the soul of the company again and would focus on restoring the oxygen of cash and earnings to the company. The transition likely means the sale of $20 billion of assets. GE will jettison businesses with a very dispassionate eye, Flannery said, keeping only units that offer growth, a leading market position and a large installed base. That could mean exiting businesses like oil and gas, lighting and transportation, closing factories around the globe, analysts said. GE plans to get rid of its 62.5% stake in oilfield services company Baker Hughes, only months after making the multi-billion-dollar investment. It will get out after the end of 2019, the earliest it can do so under the deal, which closed in July. Flannery offered no quick fixes for investors. He said power, one of the businesses GE would focus on, was challenged, but could be turned around in 1 to 2 years. Flannery added that some of its healthcare IT business, such as software for imaging and hospital staff scheduling, were still critical to the company and not likely to be divested. Dividend cut. The dividend cut to 12 cents per share from 24 cents is only the third in the company's 125-year history and the first not in a broader financial crisis, expected to save about $4 billion in cash annually. The cut will save GE $1 billion in payouts, the eighth biggest dividend cut in history among S&P 500 companies, according to Howard Silverblatt, senior index analyst of S&P Dow Jones Indices. GE also had the biggest cut when it slashed its dividend by $1 billion in 2009, Silverblatt said. GE forecast adjusted 2018 industrial free cash flow of $6 billion to $7 billion, up from an estimated $3 billion in 2017. Flannery's changes repudiate much of Immelt's vision of a digital industrial company that builds software to manage and optimize GE's jet engines, power plants, locomotives, and other products. Out-of-favor conglomerates have long been out of favor on Wall Street, where investors prefer to bet on specific industries rather than a mixed portfolio. GE is the worst performing Dow component this year, down 35% through Friday's close. Flannery's strategy is a turning point for the company, which over several decades built itself into a sprawling conglomerate with interests across media, energy, banking, aviation, railroads, marine engines, and chemicals. GE executives have said that analysts have undervalued the company's digital business. They argue the digital units should be valued more like Inc., Alphabet Inc.'s Google and other fast-growing tech companies. GE will also cut its board to 12 from 18 members.